John, you're the markets guy here. You have to recommend investments all the time. I know you have said for a while now that you think value slash cyclical names would be doing better in the second half of the year, and you also like small caps over big cap, particularly big cap growth stocks like the mega cap stocks. You still believe that? You did last time I chatted with you. And what ETFs do you like for the second half of the year? Can you give us some names that you think will outperform?
Sure. So, we run some long-dated retirement money where our time horizon is 5-10 years. So I think, small caps, if you look at EES, the WisdomTree earnings weighted small cap ETF, you have a 9 PE ratio. That's versus the Russell 2000 ETF, the IWM, which is 14 PE ratio. So that, Bob, to me looks very attractive if you believe that there's a cyclical upswing in the economy and that we're past, the recession period. U.S. large cap index is, north of 20. So, the entire U.S. market, I would say, looks, interesting once you strip out, things like SPY, SPLV, USMV, all the defensives like XLP, XLU, Cape-Shiller PE ratios in the high 20s. So I just think that if I look at the macroeconomic data, the earnings, everything looks like it has, troughed. So with the Fed anchoring interest rates at zero and they provided the floor to financial assets, they're going out and buying individual bonds and ETFs. I just think that, now is the time to strategically rebalance your portfolio.
Yeah, it's a nice in theory. The problem I have with the whole thing is I don't like value versus growth in general. I think it's an outdated investment ideology, but it's a loser, John. It's been a loser for 10 years. Now, I know you can argue on mean reversion, I guess, but, even our friend in Omaha is having a lot of problems around the whole it's time to buy value story. Is your call to buy value, but by the way, value, in case you're wondering, folks, right now is generally energy stocks, a lot of bank stocks, some retail stocks. Is your call, John, to buy value really an idea that the economy is recovering, and so instead of a late cycle play, we've already gone through the recession and now we're in an early cycle, and so you should buy cyclicals in an early cycle play? Is that the rationale here?
Yeah, and it's all how you construct the portfolio, Bob, and how much risk you put in one particular factor. We tend to be more diversified across factors because we don't want to make a big value bet. Casing, as you just said, 10-year trade, it's gone wrong. So we've been on your show many times, and we've been fortunate. We've said tilt towards, quality, tilt towards high-quality growth. So what we're saying now is that, now it's time to take profits. The idea is to buy low and sell high and buy, when valuations are on the low end. And I do think that, if I look at emerging markets, if I look at, things like MCHI, MSCI China, 12 PE ratio, the broader emerging market ETF that we use, DGRE, has also like a 11.5 PE ratio. Yeah. So to me, I take comfort in that. U.S. large cap index, like I said, the forward PE ratio in the low 20s, that's, very, very high in my eyes. Doesn't mean that it can't stay high forever, but, as somebody that strategically thinks very long time, I do think that it does make sense. And the banks that you mentioned, we have the KBWB large cap banks. I mean, to me, that feels like, a regulated entity. You've got very strong balance sheets. I think banks are well positioned. So as the yield curve, moves, steepens, and as rates go up, I think, banks should be a pretty interesting 5-10-year trade.
Dan, how do you explain to Betterment investors all of this? I guess you'd call it factor investing, quality versus low quality, or value versus growth, or low volatility versus high volatility, or momentum versus low volatility. Does any of that, as an investment category, I guess you call it factors broadly, make any sense to you? And does it fit anywhere in the Betterment universe? I'm just, Dan, I think we lost your audio, Dan. We'll see if we can get Dan back up. Oh, there you go. I'm sorry, Dan. Did you hear what I asked you there?
Yeah, absolutely.
Go ahead. Finish your point.
So one of the things that we've really focused on is positioning the investments and the investments that we put forth for clients as being about them achieving their goals. And over the past 2 or 3 years, outside of our sort of vanilla market cap-ish, globally diversified portfolio, the fastest growing and the most sustainably growing strategy that we've been putting out there is our social responsibility strategy. And I think that, it's something we offer. It's not something that we market dramatically, but we make it available to our clients. And without that marketing, without a tremendous amount of trying to push it in front of people, it's done very well. And the events of the past few months have driven more interest in that, more interest in the value of what you invest in from a values point of view. And I think that there are big opportunities now to say, how can we more refine and reflect the values of our clients in the investments that we provide for them? And that not only allows them to sort of feel like their money is going to places that they, feel, I don't know how to put it, responsible with, but also when you are invested in a portfolio for ethical or moral or any kind of like more fundamental reason than money, you tend to be a better investor in it. You're less likely to panic during downturns. You're more likely to stay the course, save reliably. Yeah. So I think that when we tend to talk to clients about value and values, it's just a very different conversation about what do you want your money to achieve.
Yeah, that's a very good way of looking at it. And when you say socially responsible, are you just talking about ESG, like plain vanilla ESG? What does socially responsible mean to you? What are they actually investing in when you say they're interested in social responsibility?
ESG is definitely the broadest framework. It's also the one that sort of right now has the most assets and therefore the lowest costs associated with the funds in it. I think one of the opportunities that we're looking at now is that different people have different values, and the ability to let each person reflect themselves in their portfolio in some sort of a scalable fashion. There are funds out there. There is a fund, NACP, that specifically looks at the advancement of colored people. I think that there are more opportunities to refine the niches that people really want to see reflected in their portfolio. I'm not sure if that's going to be a fund in the end of it. It might require something that's more like personalized indexing solutions at the individual stock level. But I definitely see that being a growing and a real growth area for any advisor who wants to have conversations with clients about their investments that aren't just what did it do last quarter.
Yeah, I think that's a very good point. And we had the head of the NACP ETF on last week, and I think you're right, Dan. What we're going to see is ESG is a very broad area for socially responsible investing, environmental, social, and governance. And I think you'll see the emergence of, I wouldn't call them more niche-oriented, but stuff that's a little more geared towards trying to attain a specific goal, whether it's clean energy or whether it's social justice. I think you're going to see much more interest in that.